Hello and welcome to this video. My name is Stanislav Bernohoff. I will be your host today. I'm a full-time professional trader with over 12 years of experience. This video is the third part of a small video course dedicated to trading gold and silver. And today we are going to talk about practical patterns and setups for trading gold and silver. Gold and silver are the same trading instruments just like any other ones, like currencies, stock indices, commodities, bonds, and so on and so forth. Yet they have some particular features which make them interesting for some particular trading styles. You can see brief contents on this slide. First of all, we will talk about island reversals, how to trade overbought and oversold market. Then we will talk about anticipation setups, how to trade breakouts in more smart way than 90% of traders do. Then we will talk about correlation trading, how to use correlation between gold and commodity currencies for the sake of taking profit. Then we will focus on seasonal trading, how to gain an edge with seasonal windows, and finally we will talk about good old classics. You might see that most of setups have to do with trader's standpoint, with short-term windows of opportunities. We are not going to focus on long-term investment opportunities today. Before we start, let's take a look at disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial and you will have full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. With that, we are ready to proceed. And the first setup which we are going to talk about today is island reversal. Often gold and silver markets move too far and too fast, giving opportunities for reversal trades. You might see sometimes very rapid price action go into some direction. The result for such action may be different. It might be political context, it might be something unexpected happening outside of the markets. Well, it doesn't matter. The first thing to see is market breaking short-term high or short-term low. It might be two-day high or two-day low with very quickly and not testing previous level like market always does. For example, it goes higher and after it attempts to test previous level, this attempt is failed. In other words, we see a small gap between previously broken level and current trading range, current consolidation. Setup which I'm showing you right now has happened April 2017, and you see that market has broken out previous 2 days high very quickly without tested 1261 level, which is short-term extreme. What is more important, that market in a process has broken out not only 2 days high, but also it has taken intermediate term high, 2-month high. It was also taken. Usually when market breaks intermediate term or long-term extreme, the auction process is over. In other words, the goal or the target of ascending move is achieved. In other words, market becomes more balanced, market becomes less trending in this case. Well, what could we see if market was trending? If market was trending, possibly it could have tested previous level 2061 and possibly would rotate back and forth before going higher. In this case, market has gone too far and too fast without testing 2061 level, leaving the gap between current consolidation and previously broken level. I call it island structure. What is island structure? It may be the triangle, it may be pennant, it may be whatever price formation which can be described in terms of classical technical analysis. This pattern is visible right above 2 days high here. It sort of stands above the trading range. This is a point where decision could be made. In such case, wait for the breakout of this consolidation phase and wait for the pullback. In this case, you see that breakout was unsuccessful. So in this case, you can plan short trades placing your stop loss order using ATR on 30-minute chart or on 1-hour chart as a basis. Multiplying it by 2, your stop loss would have been somewhere here, and your target would be somewhere in the center of the previously observed trading range. So that's the way it works. It is a reversal pattern. Now let's watch further price action. On April 11, you may notice that we had a pullback, a notable pullback here, and this market was trending. It is not an island structure. Market had broken out this level and has gone higher. And this breakout was successful. If it were unsuccessful, it may stay for a while in a trading range, then to go higher. Then we again see island structure, island reversal on April 17 here, and after false breakout to the upside, you may think about going short here, about short positions somewhere here in this point. Well, it's a short-term trade. It's not a big deal. It's not a big reversal, strategic reversal. Well, it's a short-term trade which can work for the period of 1-2 days. Now let's watch the market from different perspective, not capturing reversals but capturing breakouts. As you already know, gold and silver markets are very fast. They are less liquid than currencies, and therefore they tend to break out very quickly, and they can give profit also very quickly. Anticipation setup occurs when market leans to intermediate term high or low. It might be even short term high or low, it doesn't matter. So in case you are working with a short term extreme, make sure that you're working in the direction of some large or long-term trend. Follow the market and be ahead of the breakout. In other words, if you have a level and you see that market was showing you aggressive price action during the day and it comes closer to the level, you might go with this action and stand before the breakout. That's why it is called anticipation. You work not when breakout actually occurs, you work before the breakout actually occurs. Then again, market consolidates, establishes some short-term high, then it starts to break. Your entry point is here right before the level. So you are not going with the breakout, you're going 10-15 pips before the breakout. In terms of currencies, in terms of gold, it might be 2 full points or 3 full points, it doesn't matter. And then you go with the breakout. Well, the same thing can be executed at Friday, yet it is pretty risky trade because you should work at the closing bell on Friday. You have weekend ahead, and everything can be changed, and the market can open with the gap down on Monday, so you should think twice before entering this position. Entering position with a tight stop before the weekend is pretty risky behavior, so I would suggest not to do that. Correlation trading. Monitor markets which correlate with gold. Actually, it is Australian dollar versus American dollar. You can find opportunities as those instruments move or remain stable. For example, if you see one instrument going down and one staying in a trading or remaining to stay in the trading range, you can grasp short-term pullback and place a short position here. If you see that dollar is strengthening and Australian dollar is weakening, for example, and gold is rising, and you see that this growth is not a big deal, it's an intraday deviation from some average. You can even place a moving average here, and you see that price deviates from the mean. While Australian dollar is going down, it can be an opportunity. You can go short here, or you can sometimes be in an arbitrage trade to buy one instrument to sell another. It's a wholly different strategy which has to be described in a separate video and requires separate webinar for this topic. Okay, seasonal trading is very interesting type of trading, since we are dealing with the commodity market. Gold is a commodity, and for commodity futures, for commodity markets, seasonal windows work pretty accurately. What does it mean by what do I mean by that? If you analyze 10, 15, 20 or 30 years of performance of an instrument, you may see that it has probabilities of growing or declining within single month. In other words, for the period of 15 or 20 years, gold was rising statistically in September, and it was declining statistically in June. You may find these statistics on the web by the link that you see here. So in other words, you start focusing on window opportunities. You tend to buy gold in January, you tend to sell gold in June, you tend to buy gold in September, in November, and even in December. In other words, you're not trading every month, you're focusing on limited window opportunities, limited seasonal window opportunities. Let's watch September, for example. It is the strongest pattern which was visible on the whole set of data. For example, if we take September of 2016, you see that market is growing since the beginning of September in 2016, and it generates 5 days rally to the upside. Well, not every time it happens. Of course, your technical analysis is number one, the seasonal analysis is number two or number three. It is not the main analysis, which is the reason for the trade. It is the confirmation for a trade, not a reason for a trade. Yet you can try to use this. Okay, well, gold and silver are just the same markets like any currencies, any stock indices, any commodities like crude oil and other markets. So you can trade old good classics or good old classics. Well, what do I mean by that? On a daily charts, you can monitor for chart formations, for chart patterns like triangles, pennants, wedges, and so on and so forth. You can monitor for the breakouts of those consolidation areas, going with the breakout. Sometimes breakouts would be false. Then if you see opportunity, you may trade island structures. If you see that breakout is too fast and too rapid, you may trade island structures like it is shown here. In other cases, you might use conventional technical analysis. Well, not every time it works very accurately. Here you see that it was the election in the United States, and markets first generated false breakout to the upside, then to generate breakout to the downside. So it's a bit manipulative, but you have to keep an eye and be ready to re-enter to the opposite direction. Okay, we are coming to the finish of our video. Of course, it is a very brief explanation of what we can do with gold and silver. To discover character of gold and silver, you should monitor the market, you should watch the charts for some period of time to see how they work, how rapidly are they moving, how they act in consolidation phases. So just monitor, just observe, put down your observations in a journal, make conclusions, and finally, I hope that you will add gold and silver to your portfolio and diversify your trading. And eventually, it will lead to smoother trading performance. With that, I'm saying goodbye. This webinar was prepared by Stanislav Bernhoff, an Exness company for you. Feel free to leave your comments below this video. See other related videos on YouTube Exness channel. And see you in the next videos. Good luck.